Hello and welcome to ET Now. We are at the JPMorgan India Conference, and with me is Nitin Maheshwari and Ravi Shankar, both Managing Director and Co-Head India Investment Banking. Gentlemen, thank you very much for joining us on ET Now. Nitin, to begin with, how was the year? In the last 1 year, we've seen a wide range of issues coming in: IPOs, private equity exits. So how is it looking, and what's the synopsis for the last financial year?
So first of all, thank you for joining us. It's a very special day. It's our 10th investor conference. Happens to be that we're completing 80 years, so we're celebrating that. And today is a very special day, thanks to GST and the Navratri bringing.
Yes.
So thank you for being with us. If we reflect on the last year, there's been activity across both public and private markets. Public markets has been diversified across sectors. We've seen volume which has crossed what we did last year. There's been large IPOs, billion-dollar plus IPOs. There have been sell downs by companies who were looking to enhance their free float. And on the M&A side, we've seen activity across both Indian clients going out, international companies looking to revisit their India overall portfolio, taking it public, etc. And then private equity remaining quite active. So we've seen activity across the board, and we continue to see a lot more as we reflect on the next 6 to 18 months.
Ravi, sector specific, has there been a lot of action in particular sector?
Yeah, sure. So look, I think you can look at it, private equity on one side and corporate on another. On private equity, we are clearly seeing in tech service and infrastructure, they continue to be highly active. They're putting almost $40 billion capital a year, and a lot of that is going to these two sectors. On the corporate side, we are seeing inbound FIG very active. Obviously, you saw SMBC investing $1.6 billion in Yes Bank. But the entire Japanese and Middle Eastern corridor is quite active in that particular sector. On the outbound, people are going for market access and technology, and that's where you're seeing DI and healthcare kind of key areas where we are seeing a lot of action.
We've seen in the last 6 months a lot of uncertainty coming because of the Trump tariffs, and that's also prompting many of the Indian companies to look outbound to being near shore US or part of that US Mexico-Canada agreement, right? So are you seeing a lot of activity in that region, Nitin?
So I think just the tone has moved from waiting for certainty to navigating the uncertainty, right? That's what we are actively seeing with our clients. So each one has a different decision to take, whether it's going public or going near shore or making an acquisition. Where we've seen the most amount of dialogue and activities where we had a client who already knew a certain business that they liked, they understood that segment and the market. That's where they're taking the actual step now. As you know, Indian clients are in a good place. Balance sheets are super strong. Their valuations and their investors support growth, right? And hence, inorganic growth is very much a part of the agenda. Now, within that, what asset they will buy, it may have different reasons, as Ravi highlighted. And perhaps, Ravi, you could add on those themes which is driving some of the M&A.
Yeah, so look, I think, as I said, in DI, it's very much about getting access to technology. If you look at some of the opportunity that's out there in Europe, if you look at Tata Motors buying Iveco or Tega buying Molycop, those are basically the same themes that they're going after. And in a way, they're also globalizing their business and taking out some of the geopolitical risk in that matter.
And do you think the Indian companies have enough balance sheet to go out and buy that? Because in the last few years, we've seen the balance sheet getting repaired, leverage coming down, more cash in the books.
Yes.
So they have that confidence to go and bid for bigger companies like Tega.
Yes, absolutely. That's actually a perfect example of how a company which is like $1.5 billion, $2 billion market cap going and buying $1.5 billion company. So clearly there is a confidence, and that's coming out from two things. One, the fact that they have a very liquid currency that they can use in terms of equity, stock price, and the equity where it trades, and then you can raise capital like the Tega, which went and raised 2,000 crore, and also the very liquid balance sheet. And also, I think just the confidence that the private equity firms have in aligning with the Indian corporate and partnering to build more value. And I think the corporate governance level have been quite high in India. And that's the reason why you see, equity, debt, and partnership with private equity coming together to allow them to go and do transformational acquisition.
There's one thing to be said about the balance sheet, right? So one is Indian clients have a very strong balance sheet. The banking system globally and in India is at a good place, right? Where they're keen to lend if there are opportunities that they can finance, right? And then private equity has a lot of capital to deploy. So their idea of partnering with Indian companies to do more is a very active one.
True. Private equity also, going in a big way, collaborating or coming into a consortium and bidding for big projects or big companies now. That's something which we didn't see maybe a few years back. Now it's coming more along all big acquisitions. You have a private equity, either a structural-led or an equity coming into that. Is that the trend to go by?
I think it's the trend there is deals are becoming larger and more complex. And that's where two sponsors partnering with each other or a sponsor partnering with an LP because there's a larger check size which can take more equity is what we're seeing. But the underlying trend behind this is that there are larger deals that sponsors are comfortable doing. There are more complex deals where it's an outbound and there's a certain need in the capital structure of going beyond debt and equity to a preferred security in the middle. So that's where the complexity of deals is creating opportunities for consortiums to come together. But I won't say that consortium itself is a trend, right? We're seeing deals where single sponsors writing the checks which are larger than we had ever seen. So that will continue. But some of these consortiums come together because of a specific need in that situation.
How's the IPO market looking? Because it's also something expanding in a big way. We've seen foreign flows coming into IPOs and new capital. But while domestic market may be a little muted in terms of FI flows, the FIs are lapping up all new papers.
So look, I think if you look at IPO market last year, we had $20 billion of IPO, $70 billion of equity deals, which were second largest in the world after US, which is quite a thing to say for a market which is like fourth or fifth largest by GDP. And I think what's driving that is two things. One, on the supply of paper side, just the double-digit GDP nominal growth means that the companies which are underlying, which are coming for IPO, they are growing 15-20%. So that's a very healthy cohort of companies coming for IPO. And on the demand side, the paper is getting bought by all the mutual funds and retail, which is seeing a secular shift in the household saving.
Yeah.
Which was earlier, say, 4% of that coming to equities, now is 8%, but still a third of where US is today, right? So I think that secular shift will continue to provide a glide path for all these IPO paper to be picked up, while the growth will make sure that the quality of these paper is quite unique.
Do you think the domestic money is now not dependent on foreign money for any IPO funding?
Yeah, look, I think, first of all, FIs are indeed playing into deals. Yeah. So right now, even today, 40 to 50%.
They're not the price setters now, actually. It's the domestic funds who are the price setters.
So I think it's a balance. It's a better balance than earlier. 40 to 50% of demand comes from FII. Yeah. And from that perspective, they'll continue to play the role, an important role. What they're also doing in a number of cases is actually taking money from secondary market and investing in deals, because obviously deals, you get a certain pricing advantage. But I think it will be continue to a balance between domestic and FIIs going forward.
The FI regulations has also evolved, right? In the last 1 year, we've seen a lot of evolution coming in for IPO regulations, basically. How do you see that helping diversifying flows into India or investors coming into the IPO and into the deals?
See, overall on the regulatory front, we've continued to make it easier for foreign investors to deploy capital in India. And if you're an investor, you're thinking about two things: where do I deploy and how will I exit? I think we've consistently proven that you're able to exit investments and take your money out when you need to, and that is a sign of a mature market, right? So we're continuing to evolve in that right direction. So we're seeing a lot of focus on India from foreign investors, both the private equity bucket, the infrastructure bucket, and also the institutional money, right? So we are not seeing any dearth of dialogue. We're having one of the largest turnouts in the conference today and tomorrow, right? In terms of number of investors, the foreign institutions who have showed up. So there's a lot of interest around India. There will always be decisions they will make on different markets, different economies, and different companies. But there is an active dialogue, right? And just the number of IPOs, which are $1 billion plus, which are forthcoming in the next 6 to 12 months, it's substantial. So we are going to see that the 5 trillion market cap will expand into a much larger number. One, just the compounding, and second, more importantly, many large companies which will now be public and hence contribute to the overall market cap of the country.
So do you think the new incremental market cap addition to the Indian markets would come in from the newer issues or from secondary market valuation?
I think a mix of the two, right? Just the new paper coming in, if you think about IPO plus rights issue plus follow-on last year, that was about $40 billion. This year will be somewhat in the similar range. So I think that is not coming at a cost of money coming to secondary market, because there's a consistent shift, as I said, of the equities, which is going from household saving, from FD and real estate to market. So I think it's going to be a combination of the two rather than one versus another.
Just to get your thoughts on confidential filing, because we have new tech companies, emerging companies going for that route. How is it looking? You two have been, spearheading some of the tech big IPOs there. Yes. So how is it looking actually?
Yes. So look, I think first of all, our regulator has been quite forward-looking in terms of continuing to change and update their regulation, right? So if you go to developed market, especially US, confidential filing is the norm. In India, they introduced it a few years ago, and now it has been lapped up by a number of corporates simply because it allows them to do the right thing, which is to be in front of investor and talking to them when they're ready with all the regulatory process that they need to go through. So it's almost like a process thing where a number of issuers are taking advantage of that, and we think there are more and more people who are going to do that going forward compared to what they did last year.
Are you looking at companies from multiple sectors opting for confidential filing? Because we saw a financial services company also looking at confidential filing, but normally we would have seen the emerging new tech looking at that, right?
No, we're seeing it across sectors. We've seen it in retail, we've seen it in tech, we've seen it in financial services, as you said. So it's not a sector-specific solution. It's going to become the norm in our view in many cases, where it just allows you to have a private filing which is not public till we have decided what's the right timing. So like the US, and confidential filing is just one example, but the changes that we've brought over the last 5 years, this is all moving towards the, calling ourselves a developed economy and a mature market, both from regulatory and investment perspective.
How do you see the new regulation on IPO? Multiple tier manages liquidity coming into the market, I would say. That's a better way to put it. But at the same time, allowing company to come and, list on the stock exchanges?
Yeah.
No, absolutely. Look, I think, again, that's another example of regulator being very proactive about solving issues, right? Because if you think about our IPO, just the structure it is, where you have HNI, retail, and stuff like that, you need to make sure that you are putting stock in hands of people who understand it, and you do it in a gradual fashion. And while making sure that the interest of marginal investor, which is what SEBI is very focused on, is kind of taken care of. So I think it's a step in the right direction. And they're making sure that there's enough float for people to trade in and out. At the same time, it doesn't become like too much of unwieldy process for large companies. And that's again, a good problem to have to start with, because till now we had companies going for IPO as soon as they become $1 billion, $2 billion in value. Now there are companies which are worth $50 billion plus.
$100 billion.
And they are considering IPO. So that just shows the strength of the capital market, that it can actually fund, the private capital market can fund companies till they become larger and larger, which is the norm in the US, like OpenAI or Anthropic, etc. 600 billion or 300 billion, or they're still not public, right? So I think private capital market has strengthened, and I think this again helps companies to solve for their IPO issues properly.
Does it make life for you a little tougher, because anchor book, you have now pension and insurance companies having a little more quota coming in there, and then you have to satisfy your foreign investors, so you have to make do with less?
These are great problems to have, right? If you have more demand for companies that we're going to take public. So no, it doesn't make our life difficult, but honestly, I take it as a
and look, I think as a JPMorgan, we serve all kind of investors, right? Whether it's domestic mutual fund, FII, pension funds, in life insurance companies. So I think all of them are equally esteemed client of our firm. So I don't think it's a consideration at our end.
Maybe 5 or 10 years ago, we would have said that, okay, Indian markets can't handle a 10,000 crore IPO. I remember when the ONGC OFS happened, right, 10,000 crores, and so much of issue that came up because allocation issues, everything came in. From there to now, when we are handling 29,000 crore IPOs, do you think that Indian market is now mature enough to go above that to 40,000 crore IPOs?
Yeah, I think it's a matter of time because when we were doing Hyundai, which is $3.3 billion, about 27,000 crore, even then people had a consideration whether this is something that market can take, and market took it pretty well. So I think it's a natural evolution of the market, which is growing 15% annually. So if you think about in 3 years, it will become double, right? So what we could do $3 billion in 2024, easily we can do $6 billion in 2027. So I think it's a natural evolution of a growing market.
What about the pricing of IPOs? Do you think that market is now it's come to an equilibrium where market is able to push down the price even if the promoters wants to have a higher valuation?
I think it's
because every time we ask a promoter, they put it on the bankers, that the pricing has been set by the bankers. So what is your view on it?
So I can start, and Ravi, you should add. See, fundamentally, it's demand and supply, right? So for high quality companies, there is a long list of investors who want to be part of that journey, and they're actively participating in those IPOs, which allows us to get the pricing in the right direction, right? And I won't answer your question in the manner that you want, Sajid, but importantly, we're seeing that, let's call it a very balanced discussion happening on how IPOs are getting priced. And more importantly, we want to make sure IPOs also trade well after the listing, right? So that's the ongoing discussion and process that evolves.
It's like putting the buck on the table for when you're coming for IPO, right?
Yeah, no, look, I think the way the market works, there's always pendulum swings, sometimes this way and sometimes that way, and then the balance comes. So I think it's a natural, again, evolution where some deals don't do well, and then, for the next deal, the investor would like a more insurance, and hence then it pops a lot more, and then it pops a lot more, and then issuer comes later. So I think it's a natural kind of a yin and yang which keeps happening.
I think more importantly, all of our clients understand that IPO is just the start of that journey, right? So they want to be long-term partners, have long-term investors. They have other businesses in the group who will go public. So we have that very healthy dialogue as IPO is getting priced.
Nitin and Ravi, it was a pleasure talking to you today. Thank you very much for joining us on ET Now.
Thank you.
Thanks for your time.